Welcome to Iron Financial. I'm the lead analyst, and my mission today is absolutely straightforward: to help you forge a stronger, more resilient portfolio and cut straight through the relentless market weakness we've all been suffering through lately. Look, we don't do fluff on this channel. We deal in reinforced steel. We're talking hard numbers, massive revenue streams, debt loads, and operating margins. Because right now, inflation is proving incredibly sticky. Way stickier than anyone at the Fed wanted. And those elevated interest rates are acting like a massive hurricane-force headwind on equities. Investors are literally desperate to find bedrock. So joining me to make sure we don't blindly buy into some shiny corporate facade is the market skeptic.
That's exactly right. I am here representing you, the audience, because we all see the flashy headlines, right? We see the endless hype pumping out of Wall Street. But I want to know if these mega-cap companies are actually building something real, or if their foundation is slowly crumbling underneath the sheer weight of this brutal macro environment. So today, we are bringing you a complete, no-nonsense explainer of Mastercard's Q1 2026 earnings report. We're going to tear it down to the studs to see what's actually holding it up and figure out whether it genuinely belongs in your portfolio.
The reality is, right now, retail and institutional investors alike are spooked. The broader markets are showing some very distinct, undeniable signs of weakness, and you absolutely need stress-tested assets in your portfolios if you want to survive the volatility that's coming. My core thesis today is that Mastercard's recent Q1 report proves they are exactly that type of solid bedrock. Okay, hold on a second though. We really need to look at the tape before we start crowning them. The stock has been under massive heavy pressure. I mean, it was down about 13% year-to-date heading into this exact earnings report. And honestly, investors are terrified about the state of the consumer economy. We are seeing credit card default rates ticking up across the board, those massive pandemic-era savings accounts are completely depleted, and everyday inflation is just aggressively eating into discretionary income. So the ultimate question we have to answer today is this: is this Q1 print a genuine, impenetrable piece of armor that can protect your capital? Or are we looking at a highly dangerous value trap that's priced for absolute perfection right before the bottom completely falls out of everyday consumer spending?
Let's get into Section 1. Top line. The heavy lifting.
All right, let's dive straight into the numbers and transition into our drill-down phase. We have to examine the primary load-bearing beam of Mastercard's entire financial structure, because if the top-line revenue snaps, the whole building comes down with it. Boom. $8.4 billion in net revenue. That is some serious heavy lifting. What we are looking at represents a massive 16% reported growth year over year. And to put that into proper perspective, Wall Street, specifically the consensus of 11 different analysts surveyed by Zacks Investment Research, only expected $8.29 billion. Mastercard smashed right through that ceiling like it wasn't even there. And let's be crystal clear about how rare this actually is. Generating 16% top-line growth for a legacy financial company that commands a market cap well over $400 billion, especially in this highly restrictive economic environment, is practically unheard of. It shows an immense, almost structural level of pricing power. Look, it's a massive number. I will easily concede that point. $8.4 billion is huge, but a top-line revenue beat is really only as good as what actually trickles down to the foundation at the end of the day. You can bring $8.4 billion in the front door, but if it costs you $8.5 billion to do it, you're just bleeding out. So I need to see the rest of the blueprint before I even think about calling this a win.
While the blueprint is rock solid, just look at the foundational beat they delivered. GAAP earnings per share came in at $4.35. And when we shift over to look at adjusted EPS, it hit a staggering $4.60, completely blowing past the street's $4.41 estimate. For those keeping track, that is a 23% increase year over year. Net income landed at an astonishing $3.9 billion. But let me tell you, the absolute steel beam holding this entire quarter together is the adjusted operating margin. It sits at 60.8%. Let that sink in. For anyone modeling this at home, that implies that for every single dollar Mastercard brings in the door, roughly 61 cents drops straight down to the operating profit line. That isn't just good business, that is an absolute masterclass in operational leverage.
Okay, fine. A 60.8% margin is undeniably strong, bordering on ridiculous. But I do not blindly trust adjusted numbers. Never have, never will. Adjusted numbers are exactly where slick corporate management teams try to hide the cracks in the concrete. I want to know exactly what expenses were conveniently stripped out of the GAAP numbers to magically inflate that operating margin up to 60.8%.
Fair enough. I love the skepticism. Digging directly into the Q1 financial performance breakdown gives us exactly what you're asking for, a real look under the hood. The GAAP reported operating margin was 58.4%. The non-GAAP adjusted operating margin, as we discussed, is 60.8%. So we're talking about a 1.5 percentage point bump year over year on the adjusted side. So what did they actually adjust? Primarily, they excluded a $202 million restructuring charge alongside some net losses on equity investments. And let's be incredibly clear on that second point about the equity investments. Net losses there generally refer to unrealized mark-to-market drops on their venture portfolio and various startup investments. It is a strict accounting reality based on current market valuations. It is absolutely not operational bleeding from their core business of processing payments.
Aha! See, there it is. A $202 million restructuring charge. We are definitely going to dig deeply into that later, because let me tell you, truly healthy, thriving companies do not usually need to take massive write-offs, entirely out of the blue. But first, we need to locate the source of the water. Where is this massive 16% revenue growth actually coming from?
Moving to Section 2, the pivot, structural integrity.
What we are witnessing right now is a massive, fundamental strategic pivot. Mastercard is rapidly transforming its corporate architecture. They are moving away from just being a traditional payment rail and evolving into a highly lucrative, high-margin tech services provider. The data is right here. The traditional payment network, what we call the swipe business, which is reported net of roughly $5.6 billion in bank rebates and incentives, grew at a very respectable 12%. And remember, Mastercard literally pays those massive rebates out to banks to heavily incentivize them to issue Mastercard portfolios rather than Visa cards. It's the cost of doing business. But look closely at the other side of the ledger. Value-added services and solutions, or VAS, absolutely exploded with 22% growth. Okay, so what you are basically saying is that they are actively trying to become way less dependent on just processing traditional credit card swipes? Honestly, that's a huge relief, because domestic consumer spending is showing some undeniable, flashing red signs of what Wall Street analysts very politely like to call healthy moderation. If Mastercard only relied on the swipe fee, that 12% growth would inevitably taper off the second everyday consumers are forced to tighten their belts.
Exactly. You hit the nail on the head. They are actively forging a software firm. That 22% growth in value-added services isn't an accident. It is being heavily driven by advanced cybersecurity solutions, complex data and authentication protocols, and deep business insights. They are pouring capital into AI-driven fraud detection and what they are currently dubbing agentic commerce. But honestly, the biggest signal of all here is their definitive agreement to acquire BVNK for up to $1.8 billion. Why on earth is a legacy credit card company buying stablecoin infrastructure? Simple. Because stablecoins offer near-instant settlement speeds and they completely bypass those traditional, clunky, expensive SWIFT networks. Mastercard isn't just playing defense and protecting their turf, they are aggressively going out and buying the very underlying tech that could have eventually disrupted them. This whole services and software segment is the brand new engine that justifies a premium tech valuation, rather than settling for a sluggish, legacy bank multiple. Or here's the alternative, slightly darker take. They are being forcefully pushed into this pivot because they know full well the traditional payment rails are getting heavily squeezed by intense competition and looming heavy-handed government regulation. We need to look at the actual physical transaction volume to see if their core consumer base is actually holding up the building or if it's starting to buckle.
The core is absolutely holding strong. Look at the switch transactions. Now, these are the transactions where Mastercard acts as the actual physical technological switch between the card issuer and the merchant's acquirer, meaning they capture the full network fee. They moved from 40.1 billion transactions in Q1 of 2025 straight up to 43.8 billion transactions in Q1 2026. That is a rock-solid 9% growth rate. Furthermore, total Mastercard and Maestro cards in circulation grew by 5.2% to nearly 3.7 billion cards globally. Just think about the sheer scale of that footprint for a second. Nearly half the global population theoretically holds a Mastercard product in their wallet. Okay, 9% growth on switch transactions is definitely solid, but we have to remember the broader context here. In Q4 of last year, gross dollar volume only grew by 7%. The domestic volume here in the US is clearly moderating as the American consumer slowly taps out. The real secret sauce that's keeping these transaction numbers afloat right now is cross-border volume. They are becoming highly reliant on international travel and cross-border e-commerce staying white hot.
So, I have to step in, pause the celebration for a minute, and ask the hard, uncomfortable question. Is this growth real, or is it just market hype? We see the massive top-line beat. We see the very clever pivot to software and services. But as the skeptic on this channel, it is my literal job to aggressively interrogate the hidden risks.
Let me issue a very clear warning to anyone listening right now. If that cross-border travel boom, people flying off to Europe and Japan for expensive post-pandemic vacations, if that finally normalizes or fades entirely, this entire 16% top-line growth narrative completely collapses on itself. We absolutely need to look at the forward-looking risks that are conveniently hiding right behind that flashy $8.4 billion revenue beat.
Let's get into Section 3, the cracks, restructuring costs.
We need to shine a flashlight on the cracks in the foundation. I want to clearly introduce the explicit bear case elements here. We've talked plenty about the heavy lifting, but let's zero right in on this specific number, $202 million. This was a massive Q1 restructuring charge. My question is extremely simple. Why is a supposedly ultra-healthy, incredibly profitable company suddenly taking a massive write-off like this? Are they actively trying to sweep severe operational inefficiencies under the rug? Not at all. Actually, scratch that. It's the exact opposite. Management is being highly proactive here, not reactive. This $202 million charge is a calculated, strategic realignment entirely intended to enable rapid reinvestment. They are actively cutting costs in legacy, outdated areas, think shutting down massive, expensive physical data centers so they can migrate fully to the cloud, and simultaneously laying off redundant regional staff. They are taking the pain now so they can free up cash to fund long-term, explosive growth opportunities like the agentic commerce and AI developments we just discussed. They aren't sitting around waiting for a slowdown to hit them. They are actively future-proofing the bedrock of the company.
Fine, I hear you, but look at the broader macro picture on this breakdown. The cracks are definitely forming. We have undeniably moderating U.S. consumer spending, we have consistently rising bank rebates and incentives eating into the margins, and we have slower overall gross dollar volume. Those are real headwinds. They are real, but for every single crack you just mentioned, Mastercard has poured reinforced steel to fix it. Yes, U.S. spending is moderating, but they are specifically targeting around 14% growth in highly profitable cross-border volume to offset it. They are an absolutely unbounded global play. Just look at their structural hedges, the continued rapid digitization of emerging markets. They are seeing explosive growth across African and Asian markets. Their deep integrations with mobile money platforms like M-Pesa in heavily unbanked regions, combined with a rapidly rising Asian middle class that is eagerly adopting digital wallets, acts as a massive structural steel hedge against any domestic U.S. cooling. They don't need the U.S. consumer to carry the entire world on their shoulders anymore.
And frankly, this Q2 forward guidance brilliantly illustrates management's total confidence in their blueprint. They are actively projecting net revenue growth in the low double digits on a GAAP basis, while keeping operating expense growth constrained to only the high single digits. Wait, hold on. Low double digits? They literally just reported 16%. That means growth is definitively decelerating heading into Q2. It is a normalization against really tough comparables from last year. It's absolutely not a collapse. The critical takeaway here, the absolute gold nugget, is that they are maintaining strong double-digit top-line growth while keeping expense growth strictly boxed into the single digits. This right here is the true beauty of operational leverage in a software-oriented firm. Once the complex cybersecurity or data analytics code is written, selling that exact same software to 1,000 more banks costs them almost nothing. That $202 million restructuring cost from Q1 is already doing the heavy lifting to ensure Q2 margins keep expanding despite any slight top-line normalization.
Which brings us to Section 4, Verdict, Opportunity or Trap.
All right, we are going to synthesize all this intelligence right now. Here is the absolute worst-case scenario, what I call the bear trap. The stock currently trades at roughly 24 times forward earnings. Make no mistake, it is priced for absolute perfection. Any slip up and it gets punished. Furthermore, we always have to watch out for regulatory hurdles. If the Credit Card Competition Act in the US actually gains real legislative traction to try and break the Visa and Mastercard duopoly, or if the European Union decides to aggressively lower their interchange caps yet again, Mastercard's margin profile takes a massive direct hit. If those regulations start to bite and cross-border volume tapers off even slightly, this stock will crater and likely retest its structural support all the way down around that $490 level.
I hear the risks, but here is the bull case, the iron foundation. Wall Street analysts over on Moomoo currently have an average price target of $648.14, with a high forecast stretching all the way up to $739. The successful pivot to becoming a heavy-hitting tech and security firm is officially confirmed, and it is structurally driving those operating margins higher. Plus, we cannot ignore that management has built a highly consistent 7-quarter track record of beating and raising their estimates. In a brutal market environment like this, one that aggressively punishes companies for missing guidance by a single penny, a 7-quarter streak of flawless execution is the exact definition of an iron foundation.
So the truly crucial point for our seasoned traders out there is how we actually play this setup. The stock was down about 13% year-to-date heading into earnings, which severely lowered the bar of expectations and perfectly set up a classic relief rally. The options market had priced in an implied move of roughly 3.82%. Now, going into any major earnings print, market makers aggressively pump up options premiums because of the inherent uncertainty. But once those numbers are out in the wild, that implied volatility completely implodes. It's a phenomenon known as volatility crush. Utilizing credit spreads, specifically selling bull put spreads just below that really solid $490 to $500 support level, allows you to directly take advantage of this crush. You get to collect that inflated premium up front, and as long as the stock stays comfortably above your strike price, those options expire completely worthless. It allows you to profit heavily while maintaining a bullish to neutral bias on the underlying bedrock of the company.
We have laid out the detailed blueprints, we have rigorously stress-tested the top-line numbers, and we have clearly shown you where the cracks might be hiding. We hope this explainer gave you the raw, actionable intelligence you need to navigate this market. Now the rest is up to you. Are you actively forging your portfolio with Mastercard, viewing this impressive tech pivot as the ultimate load-bearing asset? Or do you firmly agree with the skeptic that a tapped-out, exhausted consumer makes this a highly dangerous value trap? Sound off in the comments below. Let's get a real debate going. Stay disciplined, stay entirely focused, and keep forging that iron financial strength.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.